Afternoon, everybody. Uneducated Economist here. So in today's video we are going to be discussing how it is that the powers that be want to keep the supply chain broken. Now, this is something that I have talked about quite a bit on this channel, about how it is that the Federal Reserve and the powers that be, whether it's Donald Trump or Biden or anybody else there in the administration, they all want to have a broken supply chain, keep it broken for a significant amount of time going into the future, because that is the ultimate way of creating elevated inflation expectation, which then in turn gives the Federal Reserve the ability to save their monetary policy. Now, I know I have discussed this same thing over and over again as I share with you the understanding that I have developed about monetary policy in a way that nobody else is discussing. And this is more proof of it. The truce, the tariff truce that has taken place is not a surprise to me. In fact, I would imagine that going into the future from now on, it will always be about a credible threat of a tariff that is going to be taking place at some point in the future. That is the way that they are going to do this. They don't, like, all the talk of tariffs to bring jobs back and all that other stuff, that's it's such a far off concept in order to try and to create an environment that actually that's going to occur. It's very difficult for that to actually happen. Like it's so almost impossible. However, the raising of the inflation expectation in order to save monetary policy, that is occurring. And when you see all the threats of tariffs and then the 90-day suspension and postponement and then yet again another 90-day suspension, and then like the description of what it is that's actually taking place is so confusing that nobody knows or understands what's happening, that is the monetary policy. That is what they were attempting to do, was create uncertainty and doubt within the economy, within the people's belief system, in order to raise that inflation expectation to keep the Federal Reserve from lowering interest rates. And I know this is very difficult. This is difficult for a lot of people to wrap their heads around, especially if you are very focused in on the mainstream media. The mainstream media has made people absolutely nuts. They have driven people absolutely crazy. There is no other way of deciding or thinking about how it is that the tariffs are going to impact your life outside of looking at that mainstream media and having this crazy belief about what it is that's occurring out there. I personally never once ever took any kind of major consideration about the tariffs being impactful, because the tariffs I didn't believe were going to occur. In fact, I've been saying it the whole time. What tariffs? What tariffs? Right? The credible threat of tariffs? Oh, that's very pronounced. Like, that's all over the place. There is all kinds of theories and strategies and concepts and beliefs and all kinds of stuff that's happening out there with the credible threat of tariffs, but the actual tariffs, nobody knows what they are. And every time somebody has come to the understanding that they know what the tariff situation is, they change it. So nobody knows. Nobody knows what's going on. Nobody has any understanding of it. And that is what they were attempting to do in order to create this environment. They want the uncertainty, the fear, the doubt. With all that, you will have elevated inflation expectations, which then has the Federal Reserve in a position that says, well, sorry guys, we're in a wait and see pattern. We have to see how this is all going to play out. Even though in their own words, they have a belief that the tariffs will eventually go away. I mean, this is what the Federal Reserve has said, right? Not like me trying to make it up. It's the Fed saying, yeah, once we come to a realization that the tariffs are no longer an impactful situation, we'll be able to conduct our monetary policy. Right now, they're sitting in this wait and see attitude, watching the elevated inflation expectation actually push inflation higher, which forces them to stand still, right? They don't get to move. Oh, why did you pull the message, bro? I was just about ready to go read that. Oh. Well, thanks for the $2 anyway. All right. The market's still flat for the year, but politicians got wealthy. I don't know. I mean, just the credible threat that they're not going to do tariffs once set the Dow up, what, 1,000 points today? Think about it. Nothing really happened other than that. Some words. Some jawboning went out there about, oh, hey, we're going to postpone these tariffs for 90 days. And then the markets loved it. They're like, woohoo, we're in the money. And then it shot up by 1,000 points. It's like nuts to think about, right? I left a link down in the description from a video that I had done, how long ago was this? September 27th of 2022. We're talking, years, almost 3 years ago. And in this video, I left a link down in the description. The title of it, "The Fed Wants to Keep the Supply Chain Broken." This is something that I very much believe in, what I think is occurring today. Like, this is a video predicting essentially what is occurring right now. I didn't know it was going to come from tariffs. I didn't know it was going to come in this fashion. I just thought to myself, how is it that they are going to keep elevated inflation expectations going into the future? Obviously, they're going to have to keep the supply chain broken. If you can keep the supply chain broken, then you can create the elevated inflation expectations, which then in turn keeps the Federal Reserve elevated with their Fed funds rate and ultimately starts raising the neutral interest rate, which is what the Federal Reserve was planning on doing the whole time. Like, this is exactly lining up from, if you had followed their strategies, this is lining up exactly the way that they described. As far as like being able to raise the inflation expectation, raise the Fed funds rate, and raise that neutral interest rate. All that is occurring right now. Pump and dump, wash, rinse, repeat. All right. If we get stagflation for the next quarter, a rate hike, I don't know why the interest rate adjustment would be important, right? Like, we've talked about this a lot. People ask me all the time what they're going to do with the Fed funds rate. It doesn't matter. I hope people really understand that the adjustment of the Fed funds rates takes anywhere from a year to almost 18 months to have a full impact on the economy, right? You adjust rates today, 6 months down the road, you're just now starting to feel the effects of it. A year is when you start getting the full impact. Actually, it's almost a year and a half down the road. So the Federal Reserve and the adjustment of interest rates is not important. The message that they deliver with it is, even if they don't adjust the rates, there's a message that is being delivered that is very impactful. That message is the monetary policy, not the adjustment of rates. I say this over and over again. I'm the only one who talks about this. Everybody else has a strategy and a focus that is on the Federal Reserve's adjustment of rates. I'm literally the only one who says that's not important. The only important thing is the message that they deliver with it, because that is the monetary policy. Super important to understand that, because if you're focused in on the rate adjustments, you're going to miss it. You will totally miss it. It's because that's not the monetary policy. Right? It's the communication about the rate, or the lack of a rate adjustment, but it's the communication about it. All right, your video is squeezed horizontally. What are you talking about? There we go. All right, big pun. Video is fine. Thank you. Market manipulation, market manipulation, market manipulation. Okay. Well, I mean, if you just want to chalk it up to that and then just wash your hands and say, I don't need to know anymore, then I guess you've figured it out, right? It's market manipulation and then you're done. Like, to me, I think it goes much deeper than that. Right? I mean, it's easy to just say, hey, it's simple as that. Why even look any further? These guys are jerks. It's market manipulation. All done. All right. Well, it's a lot more deeper than that. And I need to make decisions for myself based on the ideas of what it is that they plan on doing for the future. And I'm not going to just take it into consideration as just straight up manipulation and that's it. Right? I mean, there's a lot more to it. Is the Fed still quantitative tightening still? Is the Fed still quantitative tightening still? Yes, they are. It's allowing the balance sheet to roll off, right? Allowing the assets on the balance sheet to literally come due. Like when a treasury comes due and that money comes back to the Federal Reserve, they roll some of that back over into new treasuries. Some of it they pull off the market, right? So that's literally dollars coming back to the Federal Reserve. Now, to the extent that that's probably going to change soon, right? They've talked about balance sheet adjustment changes. They did some adjustments not too long ago, so the amount of quantitative tightening that they were doing has reduced, so they're not doing as much tightening, but they are still in a quantitative tightening position. They're still in restrictive economy or restrictive monetary policy. I totally agree. I believe that they seem to want higher rates. They definitely want higher rates. They want higher rates for a significant amount of time going into the future. I said it for a very long time while we were going into the COVID pandemic. They are going to keep interest rates extra low, extra long for a significant amount of time to create an inflationary scenario that is extra hot, extra long for an extended period of time to make up for the fact that they failed to achieve the 2% target. This goes back decades. Like literally decades. I could take this all the way back to like Ben Bernanke's speech from 2002. Really, if you just go back to 2018, you can find that in John Williams' speech talking about how the low neutral interest rate was going to destroy the monetary policy and that they absolutely needed elevated inflation expectations. I mean, he spells it out in November of 2018, monetary policy strategies for a low neutral interest rate world. Very difficult speech to get through, especially if you're just new to the Federal Reserve or even new to the credible threat theory. That speech is just so confusing and just blows people away when they finally start to understand what it is that he was trying to communicate inside of it, because what we are experiencing today is exactly what he was wanting for the strategy for a low neutral interest rate world. A lot of people don't even know about that. Like the low neutral interest rate, which is the Federal Reserve neither accommodating nor restricting the economy, it's when they were neutral, was very close to zero. They even said it, when it comes time to stimulate the economy, they would not be able to lower interest rates significantly below that neutral rate without hitting the lower bound of zero. They had run out of policy. This so crazy to think that they were admitting it and nobody was hearing it, and they changed the way that they conduct themselves. And they said, hey, we're not going to be able to use the interest rate adjustments anymore. It doesn't work. We're at the lower bound of zero interest rate policy for 10 years. They didn't adjust rates, but they used communication to adjust the monetary policy, and that's what they are doing today. Everybody is so focused in on rate adjustments that they can't see it any other way. It doesn't matter what we do with the rates because their words are the effective tool, but when they threaten to cut rates, but when will they threaten to cut rates? They will threaten to cut rates when unemployment rises. When the labor market becomes weak, that's when they will cut rate. That's when they'll start to cut rates. But right now, if you go and you look at the unemployment, and I know a lot of people are going to say the same thing like they always say, it's just like the unemployment numbers aren't real, bro, it's way worse. Okay, totally get it. I agree. Labor market is a lot weaker than what they are putting out there. Unemployment's a lot higher than the official numbers. Doesn't matter, right? It doesn't matter what we think or what we want. They have a monetary policy that is using that information, their unemployment numbers. Whether we agree with it or not doesn't matter. We were trying to figure out what they're doing with their monetary policy. We have to look at those unemployment numbers, and when that unemployment number rises significantly, like higher than it is from the historically low number it is today, when it starts to rise significantly, the Federal Reserve will be mandated to do something about that, and that will be the lowering of rates. You won't see it until unemployment rises or the labor market gets weak, however you want to look at it. But until then, we have elevated inflation expectations, which is going to force the Federal Reserve into the second part of their mandate, which is stable prices with low inflation. There we go. And since the fear and uncertainty and doubt about tariffs and trade wars and supply chains is going to keep the elevated inflation expectation going into the future, since that's the case, most likely you are not going to see the Federal Reserve in any kind of hurry to lower rates. We got strong jobs market, low unemployment, and credible threat of tariffs that is going to create an elevated inflation expectation. The Fed is right where they want to be. Right where they want to be. This is not painful for them at all. In fact, they're sitting around doing nothing. They're not doing anything. They're sitting on their hands waiting. Let's wait and see. Got to see what those tariffs turn out to be like, Till then, we're just going to sit on our hands and do nothing at all. And they've been doing that for a long time. The only thing they do is actually talk. That's it. They just use a bunch of words, and that's it. All right. Hello, Simon. In what hypothetical scenario do you think the Fed goes back to the zero lower bound? Liquidity crisis in the bond market, like Liz Truss UK moment. Federal Reserve back to the lower bound to zero. Yeah, it would have to be a full-on economic crisis, financial crisis or something like that, credit markets freezing up or something of that nature. It's going to take something pretty significant for them to lower rates. If that was to happen, you would see unemployment shoot up. So in that sense, like, the dual mandate will eventually force them into that sort of reaction of lowering interest rates back down to the lower bound of zero, because you're going to have to get it far enough below neutral in order to stimulate the economy. Most likely, the neutral interest rate hasn't risen significantly enough yet to actually stimulate the economy when they drop it back down to zero. So then that would also force them into a lot of quantitative easing and something of that nature. I don't see that on the horizon. I know a lot of other people do, but I don't. Right? And when I think about what it is that's going to force the Fed into moving the rates down, it's going to be a rise in unemployment. It's going to be a weak labor market. And although I can see that happening, like a possibility of that happening into the future, it's not occurring at this time. So give it time and maybe that'll change. But at this moment, no. They're going to be like, well, we're wait and see. Elevated inflation expectations due to the credible threat of tariffs is going to have to keep us right here in a wait and see pattern, data dependent, All right. Finally, a good non-rhetorical question. Has China announced pause market manipulation? The poor labor market is certainly coming, right? And now I've heard that for how many years now? Like, basically since the pandemic. There's just like everybody's going to get laid off and nobody's going to have a job and there's going to be a huge recession. And I kept hearing that over and over again. I came up with that, recessionless recession theory. I think that's played out. We have a new idea that is now coming into where it is that the Federal Reserve wants to be positioned for the future. And ultimately, if you can keep the credible threat of tariffs and keep a broken supply chain into the future, you're going to keep elevated inflation expectations. If you can keep elevated inflation expectations, well, then you're going to have to combat that with elevated interest rates, which is what the Federal Reserve truly wants, because with elevated inflation expectations, elevated interest rates, you are going to start pulling the neutral interest rate ever higher, which was the Federal Reserve's main problem that they needed to solve. This isn't me saying this either. I mean, I want everybody to know that this is all coming directly from the Federal Reserve itself. Now, I do have a tendency to paraphrase or whatever, but ultimately everything that I talk about, I can prove through a Federal Reserve document or statement that they had given in the past. Really, go and check out Monetary Policy Strategies for a Low Neutral Interest Rate World. That's the name of it, right? Monetary Policy Strategies for a Low Neutral Interest Rate World. In that speech, he lays it straight out. He said it. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. That's right here in the speech. And he goes on to talk about what it is that they plan on doing. One of the things that they're going to do See, he says it right here. What does a low neutral rate mean for monetary policy? See, this is the problem. A low neutral interest rate. What does the neutral interest rate mean for the monetary policy? When a recession hits, central banks may not be able to reduce the Fed funds rate, right? Reduce interest rates well below their neutral level to stimulate the economy as warranted because of the effective lower bound. So the Federal Reserve is here. Neutral is somewhere right below them, the federal Fed funds rate, and then right below neutral is zero. They cannot drop the Fed funds rate far enough below neutral before hitting the lower bound of zero. It's no longer an effective tool. This is what John Williams was saying way back in 2018. They were screwed. They screwed up. They had no monetary policy with the adjustment of rates. He said it, like, let me read it again. When a recession hits, the central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted because of the effective lower bound. Okay, that's zero. On nominal interest rates, this shortfall in monetary accommodations would result in less desirable economic outcomes during recessions and recoveries. In particular, inflation would typically undershoot its desired target from these episodes. Inflation would undershoot. The persistence of below target inflation rates in many advanced economies over the past decade is a testament to this dynamic. They were suffering with too low of inflation and inflation expectations back in 2018. Scared of deflation. They couldn't find inflation. They were desperate for it. They were looking for it everywhere, and the lower bound of zero and the low neutral interest rate meant that the Federal Reserve had run out of monetary policy. They couldn't stimulate the economy anymore. That's why they went and did all that money printing, the quantitative easings. That is what essentially drove the higher inflation expectations. Okay. How are they planning on solving this? Average inflation targeting, whereby the central bank purposefully aims to achieve an above target inflation in good times. In good times, right? Yeah, got to remember, these are the good times. Unemployment's low, right? Good times. During good times when the lower bound is not constrained. What do they want to do? Whereby the central bank purposefully aims to achieve above target inflation in good times. When the lower bound is not constrained, properly designed and implemented, such an overshoot can offset the inflation undershoot during bad times so that the long run average inflation and inflation expectations are in line with the target. This is what John Williams was suggesting that the Federal Reserve do back in November of 2018. Prior to the pandemic, prior to COVID, prior to the inflationary scenario, and prior to the supply chain breakdown. This is what John Williams was suggesting. Hey, we're screwed if we don't. However, there is a plan. If we allow inflation to run extra hot, extra long for an extended period of time, we may be making up for the fact that we failed to achieve the 2% target over the previous 10 years. This is John Williams saying this. This isn't me. This is him, right? And now when you think about the situation that we are now in, we got elevated inflation expectations. We have a broken supply chain, and the Federal Reserve going, I don't know, we're going to have to keep interest rates extra high, extra long. I wonder how. I wonder why this is the case. 7 years ago, maybe because you said that that's what you were going to do. Right? And it wasn't just him. There's all kinds of it. There's something called the makeup strategy. Kid you not. Like the Federal Reserve has a 20-page document that says how robust are makeup strategies to key alternative assumptions. Right? Makeup strategies work best when the public understands, believes, and reacts to policymakers' commitment to offset misses in inflation from the 2% objective in the future. In particular, makeup strategies are most powerful when policymakers can influence the public's inflation expectations. If they can influence the people's inflation expectations, in doing so, policymakers face a dynamic tension. They must maintain long-run inflation expectations around 2% objective while at the same time moving short-run inflation expectations in response to the new strategy. They got to maintain a 2% target, but they got to elevate your inflation expectations today. How many people are thinking that the Federal Reserve is going for a 2% target and maintaining elevated interest rates to fight inflation? This is lining up with the makeup strategy. Exactly what they were looking for. Long-term inflation expectations at 2%, well anchored there, and current inflation scenario elevated. Bang! Right in line with what it is that they were asking for, looking for. This document came out when? This is an old one. This came out 2020. In 2020, this thing came out. 4 years ago, 5 years ago now. See, this is how I know that everything that you're finding on the mainstream media is pure propaganda. I mean, I don't know how many times I've said it. What tariffs? What are we going to see for tariffs? How are these tariffs really going to, what are the workarounds? What are the exemptions? What are the postponements? Right? All this credible threat of tariffs does what? One main thing that it definitely does. It raises the inflation expectations. Perfect. Right in line with what the Federal Reserve needs. Right? And everybody falls for it. I mean, literally everybody. Nobody sees the Federal Reserve's monetary policy strategies in the light that I have shown. And I don't know why. It's right here, black and white, crystal clear, spoken out through their own words to each other. If you are looking to the mainstream media, if you are looking for an article, if you are looking for somebody who is going to describe monetary policy like I have done it, they don't exist. There is nobody else out there doing it. The only way you're going to get this information is if you dive into the speeches yourself, because that's the only place that is being discussed. And these speeches are to the other central bankers. They don't, I don't know why, but the mainstream media doesn't cover any of this stuff. You want to read a really good one? Go and read, which one is it? It's Jefferson. Phillips Jefferson has two very, very incredible speeches. And one of them was just, what is it? Let me go back here and... All right. This is Communicating About Monetary Policy. This thing was given May 13th of 2024. This is again by Phillips Jefferson, Vice Chair, Board of Governors of the Federal Reserve System, Central Bank Communications Theory and Practices. Now, this speech talks all about monetary policy, communication about monetary policy, and doesn't mention anything about interest rate adjustments. They do talk about interest rate adjustments, but not being the monetary policy tool, but a communication about those interest rate adjustments. This is what's amazing about it. They knew that this was going to be the case, right? It says here, in 1981, Karl Brunner, the Swiss monetary economist, called central banking an esoteric art and lamented central banks' quote, inherent impossibility to articulate its insights in explicit and intelligible words and sentences. They were basically saying back in the day, there's no way that a central banker can communicate to the people. There's no way. They just simply cannot do it. They don't know how, right? Inherent impossibility to articulate its insights in explicit and intelligible words and sentences. This is what the central bankers were saying about communication to the people. They couldn't do it. Impossible. At the time, central banking wisdom dictated that monetary policymakers should say as little as possible. Some research of that vintage tried to rationalize this, quote, secrecy through the notion that monetary policy would be particularly effective if it surprised the markets. That's the way they used to conduct themselves, in secrecy, adjusting rates, shocking the markets with those interest rate adjustments. That is no longer the effective tool. Expectations became a focal point. Expectations became the focal point in academic and policy circles with the emergence of a new Keynesian models in the 1990s as the framework for monetary policy. See that? Expectations is now the monetary policy. In these models, aligning the expectations of decision makers, that's people like you and me and the business owners and investors and everybody else out there, aligning the expectations of decision makers in the private sector, again, that's you and me, with those of the policymakers, the Federal Reserve, produce superior economic outcomes. Their words and your beliefs produce superior economic outcomes, not the adjustment of rates, your belief about what it is that's taken place and their communication about it. Mike Woodford, one of the developers of the new Keynesian model, put it this way: not only do expectations about policy matter, very little else matters. See how many people are focused in on the interest rate adjustments, but the Federal Reserve and the other policymakers out there are focused in on their communication about it? That's the difference. They want people focused in on the interest rate adjustments, and everybody is, because they don't know anything else to look at. Meanwhile, it's their communication about it that is now guiding the expectations and creating the monetary policy that we now experience today. That's a huge difference. All right. Cruising to the bottom. Oh my gosh, look at all these. Okay. Faith in the dollar. USA already wealthy. We live in abundance. You're absolutely right, Kirk. I couldn't agree with that more. Absolutely, we do. Whip inflation. I've never heard of it. Enlighten me. Whip inflation. I don't know about whip inflation. I don't know what that means. I know what bullwhip effect means. All right. Why are they so afraid of deflation? Is that when everybody realizes they're worthless? Aha. Okay. Okay, so first of all, there's two places that you can go to talk about that exact thing. One of them is in Powell's speech, right? The persistent, because he says right in here, that some would find it counterintuitive that the Fed would want to push up inflation, right? The persistent undershoot of inflation from our 2% long-run objective is a cause for concern. Many find it counterintuitive that the Fed would want to push up inflation. After all, low and stable inflation is essential for a well-functioning economy. And we are certainly mindful of higher prices for essential items such as food, gasoline, shelter, add to the burdens faced by many families, especially those struggling with lost jobs and incomes. However, inflation that is persistently too low, right? Without persistently too low, if it's deflation, it's absolutely horrible the other way. However, inflation that is persistently too low poses serious risk to the economy. Inflation that runs below its desired level can lead to unwelcome fall in long-term inflation expectations, which can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. This dynamic is a problem because expected inflation feeds directly into the general levels of interest rates. While anchored inflation expectations are critical for giving the Fed the latitude to support employment when necessary without destabilizing inflation. But if inflation expectations fall below their 2% objective, interest rates would decline in tandem. In turn, we would have less scope to cut rates to boost employment during economic downturns. It would create a situation in which that there was no stimulating effect. Right? Deflationary scenario would then give the Federal Reserve a position in which that they could not stimulate the economy. That is a bad deal for them. We've seen this adverse dynamic play out in other major economies around the world and have learned that once it sets in, it can be very difficult to overcome. We want to do what we can to prevent this dynamic from happening here. They are trying to prevent that from occurring. Scared of the deflationary scenario. They would not be able to stimulate the economy, especially with the rates being as close to the lower bound of zero as they are. Right? So for most people, when they look at it, they think, oh no, let them fail, let it all go down. People don't need to be in debt. They don't need to be doing all this other stuff. And I totally agree. There's a lot of that goes on out there. But when you think about when you have a rise of unemployment, a massive amounts of bankruptcies and business, defaulting and going out of business, when you have a massive amount of that, you're going to find a bunch of people who are very frustrated sitting down there in poverty trying to figure out how it is that they get out of it. And if a deflationary scenario is still prevalent within the economy, there's nothing that can do. They can just sit there in a dead economy, right? This is why the Federal Reserve is so adamant about keeping the interest rates elevated so that they have the room to stimulate once they drop those rates far enough below neutral. Without their position for that, then they're left up to these, very obscure, what do they call it, unorthodox monetary policies like that of quantitative easings, those asset purchases and stuff. What time is it? It's time. I got a few more minutes left here, guys, and then I gotta go. But I'm glad so many people are up in here. We got 497 people watching with 101 likes. Please, everybody, go hit that like button. By hitting the like button, the YouTube algorithm will grab the video and spread it around for more people to join in, and we can continue this conversation once the video gets uploaded. Dropping rates in a deflationary situation would probably do very little. Well, absolutely it would, beloved, and I'm going to answer your question because they can't get it far enough below neutral. So yes, you're absolutely right. Dropping rates in a deflationary scenario at this point would do very little to stimulate the economy because they don't have any room to actually stimulate the economy. All right, they can't get far enough below neutral. All right. If Americans stop spending their way to a life of work and debt is the only solution. Smoke that thumbs up like Cheech and Chong. Thank you. Wayne, agricultural depression, the draining of gold in the U.S. Treasury due in part to increased mandatory silver purchases since 1890 and reduced international trade due to McKinley tariff of 1890. I have 0 college education and AI told me retirement plan is 95% successful. I have looked at a bunch of AI stuff and I can tell you right now that AI is garbage. Like, I cannot find anything accurate when I look at AI stuff, especially when it comes to like monetary policy and stuff. AI sucks. It's terrible. All right. How can we handle the upkeep of decaying building across the country? You can't. Okay. AI is learning from us, so yeah. You guys are awesome. All right. Let's call it quits. This was a lot of fun. Thank you all for being here. I really enjoyed the discussion. Proven the credible threat theory yet again is taking place as we see the postponement of tariffs going into the future that creates elevated inflation expectations. This in turn raises the neutral interest rate, and this is what's giving the Federal Reserve the ability to find their ammunition that they are needing so that during the next downturn, if they are to lower interest rates, they can drop them far enough below the neutral interest rate to actually stimulate the economy again. This is what I believe has been taking place for years now, and it is playing out very much in line with that theory. So thank you all for being here. Thank you very much for hitting that thumbs up button. And hope to see a bunch of you down in Orlando at the Rebel Capitalist. So we're going to be heading to the Rebel Capitalist at the end of the month here. I'm not going to be speaking at this particular one, or at least not yet, but I will be there hanging out. So I hope to see a bunch of you there in Orlando. All right, Uneducated Economist is underrated. Well, thank you so much. I appreciate that. You guys are awesome. Thank you for being here. You guys let me know.